Today we're going to dig into what might just be one of Italy's best-kept secrets for investors. It's a utility giant called A2A, and its story is pretty fascinating. It all starts with one very powerful number.
To really get what A2A is all about, you've got to start with this number right here, 28.
That's right. For 28 straight years, A2A has returned cash to its shareholders just like clockwork. Now, in the often turbulent Italian market, that kind of consistency, well, that's a serious beacon of stability.
So, who exactly is A2A? Think of them as the fundamental backbone of northern Italy's entire infrastructure. They're the ones generating the power, managing the trash, and running the water and electricity networks for millions of people in the country's economic heartland.
Okay, so let's get into the details. If you really want to understand where A2A's true strength comes from, we've got to look at its most powerful and maybe its most surprising business segment.
So, A2A's business is nicely spread across three main pillars. You've got energy, networks, and the environment. But the real gem here, the part that gets analysts truly excited, is what they do with trash.
And why is that? Well, because in Italy, if you want to build a new waste-to-energy plant, getting all the permits and approvals can take, get this, over a decade. Meanwhile, A2A already operates more than 70 of them. It's what you'd call a competitive moat that's practically impossible for anyone new to cross.
And this is where their business model gets really brilliant. Check it out. First, cities and towns pay A2A a gate fee just to take their garbage. Then, A2A incinerates that garbage to create electricity and heat, and they get paid a second time for selling that energy. It's a fantastic double dip.
So the key takeaway here is that this fortress, literally built on trash, generates an incredibly stable and predictable stream of cash. It's the kind of business that just keeps humming along whether the economy is booming or busting.
But you know, every fortress has a potential vulnerability. And for A2A, that weakness is the very ground it's built on, the nation of Italy itself.
And this creates the central conflict for any investor looking at this company. You have this incredibly solid, well-run business, but it's operating inside an environment that's famous for political and regulatory surprises. It's a real tug of war.
On one side of that rope, you have the bull case, and it's super compelling. I mean, it's all built on that incredible 28-year dividend record, that nearly unbreakable moat in waste management, and the just sheer amount of cash the business spits out.
But on the other side, you've got the bear case, and it's all about that Italian risk. We're talking about unpredictable new taxes that pop up out of nowhere, political instability, and the huge, huge ambition of their new spending plan.
This new IRAP tax is the perfect example. It's a direct hit to profits, introduced by the government. And while they say it's temporary, it's just a stark reminder to investors that the rules of the game can change on you overnight.
So with this constant battle between a great company and a risky country, how does the stock market actually value A2A?
Which brings us to the multi-billion-dollar question, right? Is the market so focused on the Italy part of the story that it's completely missing the quality of the A2A part? In other words, is there a huge opportunity here?
Well, the data shows a really interesting gap. A2A trades at about 6.4 times its core earnings. That's a common way to value these kinds of companies. But its European peers, they trade closer to 8 times. That's a huge 20–30% discount. Basically, the price investors are making them pay for having an Italian passport. And that discount is there even while the company is generating an absolute torrent of cash. And that brings us to our next really important number, which highlights the engine at the heart of this whole business. Yeah, an 11.9% free cash flow yield. That is massive. To put that in perspective for you, imagine a business that, after it pays for everything it needs to run and maintain itself, generates cash equal to almost 12% of its entire stock market value in just 1 year. That's an incredibly powerful engine under the hood. But all that cash generation has a massive new job to do. There is one more gigantic number hanging over this company's future, and it's this one, 23 billion euros.
That is the staggering size of A2A's 10-year investment plan, and it's focused mostly on renewables. An amount this large, it just raises a critical question. Is this a bold bet on the future that's going to fuel incredible growth? Or is it a potential burden that could really strain the company's finances?
So, let's put all these pieces together. What's the final analysis here? And what are the key things we should be watching for going forward?
It really boils down to this classic investor debate. Are you getting a wonderful company at a fair price because the market is just overreacting to the risks? Or are those risks, the politics, the taxes, that huge spending plan, a trap that's just waiting to spring?
Ultimately, the verdict here is that for an investor who's really focused on resilience and income, A2A's core strengths make a very, very compelling case. That 28-year dividend history, it just speaks volumes, even with the clear dangers of its home country.
But listen, this isn't a static story. The whole narrative could change, and fast. So the final question is, what happens next? You've got to keep an eye on these key events, from earnings reports that'll show the real bite of that new tax, to rainfall levels that affect their hydropower, to potential merger news. These are the catalysts that are going to tell us once and for all whether the bulls or the bears got this one right.